What is up, guys? Welcome to another FBA happy hour. We have Chris Potter as our guest. We'll be talking all about Amazon accounting and FBA or e-commerce. He has a ton of experience doing pretty much everything. You guys always ask a ton of questions about taxes that we don't want to answer because we are not professionals. So we figure we would bring on a professional to answer your questions. Chris has run an 8-figure Amazon business. He's done drop shipping. He'd probably be very busy right now because he used to do Halloween stuff on Amazon. So we're really happy to have him. And then he's also founder of Tall Oak Advisors, which he'll go into. And yeah, ask away your questions. We have a hard stop at 4. So let's just get in all the questions. We have a bunch of questions. I think a bunch of people wrote on Instagram the questions they had. So we'll kind of go through those. But without further ado, you want to just kind of introduce yourself and kind of go over your history?
How am I supposed to do that after you just did it?
I don't know. I was just like, I don't know. I was like trying to think.
I mean,
I
I
was
could
listening to
talk for 10
something
more
and
minutes if you
like,
want.
you shouldn't just ask like, "Hey, tell us about yourself." So I was like, "Well, I'll do a little," and then let him finish it.
Yeah, I think you did a pretty good job. I mean, I could go on for 15 minutes, but I know it's not what you guys want to hear today. You guys want answers to your questions. So, yeah, I mean, basic background is like you said, I sold for about 12 years between Amazon and eBay. My largest business was we did about 13 million, our highest year we had. I've done every business model from drop shipping to wholesale to arbitrage, you name it, I've done them all. Now I transitioned out of that operation and I bought tax businesses 3 years ago. And now we do e-com, bookkeeping, and taxes. And this last year, we helped about 200 plus clients just over the last year, helping them out with taxes and bookkeeping. So we're ready to answer your questions. And one thing to keep in mind is that I am not a CPA, but I know a ton about taxes. I own tax firms, but it doesn't necessarily mean I'm personally a CPA. I have CPAs on staff. It's not me. So anything that you're learning here in today's call is taken with a grain of salt, if you want to put it that way. But I do tend to know what I'm talking about when you're asking these questions. So I just put a
Yeah, more
disclaimer
than
out
we
there.
know. A lot more than we know.
Yep.
What is up, Miguel? We do definitely have a smart guest. So we'll start with Instagram. Let's see here. It says, what are some tips for maintaining my books before I can afford a bookkeeper?
Okay. Good question. We get that a lot, actually. So I would say that if you're going to do anything, you should get Seller Board or Inventory Lab. I'm assuming this is mostly for someone who's probably in the arbitrage space or wholesale space. And
Probably,
those are
yeah.
typically the tools we typically recommend for those people. And we actually have put together a business tax worksheet for clients like that, where basically what you're doing is you are tracking everything in Seller Board and Inventory Lab, putting your buy costs, that sort of thing. And then utilize the spreadsheet that we have to track all of your other expenses. And if you do those two things and you come to us wanting to have taxes, usually we're in pretty decent shape. And I would say that once you get to somewhere between $10,000 to $15,000 per month in revenue, that's when you should start thinking about potentially hiring a service to do bookkeeping at that point.
Okay, cool. Yeah, no, that's a really good point. I guess while we're on that, what are kind of some of the differences? Because I think a lot of people are going to ask between working with someone like you versus just relying on inventory labs and seller board.
So there's a few things. The biggest thing that has nothing to do with what Inventory Lab does is that you have no real true picture of what your entire business is, because you're not getting a cash flow statement and you're also not getting a balance sheet. A balance sheet pretty much outlines where all of your assets are, shows all your liabilities, and then tells you what your equity is. It tends to happen when people are just running things through Inventory Lab or Seller Board. They're kind of like they're buying stuff and they're selling it, and they're seeing all this supposed profit and all of this stuff going on in Inventory Lab. But then when they try to make their credit card payments, they're like, well, where the hell did my money go? and that's pretty commonplace. We see this a lot. And in some cases, it's because you're like so highly leveraged on your liabilities that your assets aren't even good enough to support the liabilities that you have. And in some cases, we've also seen that people start taking money out of the business way before they should. And realistically, you shouldn't do that unless you fully know where you're at equity wise. And if you're not running any sort of balance sheet, you don't know what your true equity is, and it makes it very difficult to know whether you can pull money out. There was a case earlier this year where we had a client that came to us, and they were using Inventory Lab. And as they're told, they're doing okay. Their profits showed X. I'm not going to say what it is, but profits showed X, and they were pulling out of the business pretty much exactly what their profits were throughout the entire year, which
Jeez.
is obviously a problem. And then when you looked at the liabilities versus how much assets they had, because they were not actually really profitable, they were barely profitable. They actually pulled out like $40,000 out of the business, and they were not profitable by the time you actually ran the proper numbers. So they basically sucked out all of the money they had in their business. They were like way over leveraged. Like their equity was probably like negative $60,000, and like it was rough. But Inventory Lab showed them that they were profitable, but they weren't. And so like that's kind of like an example of you just really don't know where you're at unless you truly have the full picture, and generally you don't have that when you're running just Seller Board or Inventory Lab. And there's other reasons too that kind of account for this, like Inventory Lab doesn't account for all of your inventory that's not at Amazon or in transfer to Amazon. So there could be items that you've purchased that you've paid money on your credit card but never got delivered. Maybe there's items that you have in transit, maybe you have stuff at the prep center, and none of that's accounted for when you're looking at anything in Inventory Lab. And so you can account for that when you're doing proper bookkeeping. You can account for where all this stuff is at, so we have a full true picture. And that's kind of what it boils down to. You just need a full picture.
Can you go into a little bit more about like the equity? Like, what do you mean when you say equity in the business? And like, maybe when should you be taking money out? Because everyone always asks, like, hey, when can I take money out? Like, I'm putting all this money in, but when's a good time to take it out?
Yeah. So when you're talking about equity, it's a basic balance sheet function. So pretty much assets equals liabilities plus equity. So another way of looking at that is if you take all of your assets, which the assets we're talking about would be all the cash in your bank accounts, all the money in the reserve accounts at Amazon, all of your actual inventory that you physically have. If you own like a vehicle that's owned by the business, that would be another example of an asset. If you own a warehouse, it could be all the forklifts you have in the warehouse. So all of that stuff would be your assets. And your liabilities would be stuff like stuff on your credit cards. It could be an Amazon loan against your car that you purchased. All of that stuff is your liabilities. And you basically take your assets, deduct your liabilities, and then at the bottom are is your equity. Now, what's also part of equity is that when you pull money out, like let's say you have $1,000, your equity would actually be negative 50,000 because you pulled out what you actually made, basically, as far as like assets minus liabilities. So there's functionality in that as well. But the basic gist of it is that when you kind of like add it all up, it basically tells you really what you're truly worth. Now, the question is, like you said, when should I start taking money out? Realistically, you should take a look at that actual asset number. I'm sorry, the equity number, see what the true equity is in your business, and then measure that along with how much working capital you actually need within the business to make it operate. And that usually is the biggest problem with inventory-based businesses, is that you basically have two options. You either have to reinvest your own money into the business, or you have to take out loans. And if you're continuously reinvesting money into the business, it's going to be very, very difficult to have that like hockey stick growth curve and take money out. You can't do both unless you take out loans. And so that's kind of like where you have to look at those numbers and determine, okay, well, my working capital is how much I actually need to operate the business is this amount of dollars per month. I know I have this much equity in the business. I can feel comfortable taking this out. And sometimes what we also recommend too is if you literally have no clue, is just start taking out like $500 a month and see how it feels. See how it feels. Does it make your business tighter? Do you have even harder time actually paying your bills? And if it feels rough, then you probably can't afford it. Don't start taking out like thousands of dollars because you saw $5,000 of profit and you're like, sweet, I'm going to go take out $4,000, leave 1,000 in the business, and I'm good. Take it slow. Do 500 a month, maybe 1,000 a month. Do that once. See how it feels. If you're seeing it's really strapping your cash and your equity is like terrible, then no, don't do it. But if your equity is okay, take out $1,000. It feels okay. You're still able to make your payments. You're still able to do what you need to do. Then maybe up to the 1,500 and that sort of thing.
Got it. Yeah, that makes a lot of sense. And yeah, that's always like, it's always great to see the growth. But like, yeah, I do feel a lot of people don't realize like if you want to do 100K in sales, like you got to spend like probably like 40 to 50 grand. Like it just doesn't happen on a 10K spend.
No.
How do you best keep track of return back to stock value on cost of goods between Inventory Labs and QuickBooks value?
Okay, so what I'm assuming what he's referring to here is that there's inventory that gets returned and there's sellable inventory and then there's unsellable inventory. And inventory lab theoretically takes care of that, theoretically. We don't know for sure exactly what they do because you can't actually export the profit and loss statement and see how it came up with the numbers. You just can't.
Sure.
So they tell you theoretically it does, but you can't verify this. And that's also partially an issue you have with both inventory lab and seller board is if you want to verify the information they're telling you, you just can't. You just can't verify it.
Yeah.
With QuickBooks, you definitely can. So back to the original question at hand here is what do you do with it? So what will tend to happen is that over time, you will notice that the numbers between inventory lab and the numbers between QuickBooks are almost always out of alignment. And the reason why they're out of alignment is because there's inventory that just moves all over the place. And realistically, even with us as a professional bookkeeping company, we never get it right. We never get it perfect, and no company does. The day you actually have your inventory right is the day you go out of business and you're at $0 inventory. That's the only day you're going to be accurate the entire time you're operating your business. So really what you're trying to do is you're trying to get the best educated guesses you possibly can based on the information you have. So when you see that there's a huge difference between Inventory Lab and QuickBooks, you have to basically do an inventory evaluation to determine where all this inventory is at. So what you'll typically want to do is say, okay, well, how much inventory do I actually have in my house? How much do I have that I've ordered but isn't delivered yet? How much inventory do I have sitting in a prep center that has not been checked in yet? How much inventory do I have that's sitting around that was the wrong stuff that I ordered that just hasn't been refunded yet by a supplier? Add all that stuff up, then add in how much your death pile is that's sitting that's sitting in your corner of your warehouse or your garage, wherever you have it. Then you take a look at the numbers Inventory Lab shows you that's actually sitting at Amazon and how much is actually sitting in transit. And you kind of like add all these numbers up, and theoretically they should be pretty close to the same. If they're not, by doing all the various adjustments, that means there's money lost somewhere. And generally the money is lost from various places. One, it could be unsellable inventory you just haven't tracked in some fashion. Because there's another case where Inventory Lab won't necessarily show all of the unfulfillable inventory. So you have to like do a removal order, and then where does it go after that? Who knows? Do you liquidate it? Who knows?
Yeah.
In some cases, if you liquidate it, it will get pulled out of Inventory Lab's numbers, but it doesn't really show up anywhere. Like the cost of goods sold doesn't show up anywhere. Whereas in QuickBooks, you actually have to make an actual manual adjustment for all those returns. And same thing with those unfulfillables. Once you return them, you've got to do an adjustment. You also have to do an adjustment for cost of goods sold for anything that you've been reimbursed for as well, which I have no clue if they actually include that with Inventory Lab or not, because I don't know. I think they do, but I'm not
think
sure.
there is a line that says reimbursements. I'm not sure what it's for, but
Yeah, you get the reimbursements. Yes, you get the income from it, but do they calculate the cost of goods sold associated with that?
oh, got you.
Because you got to remember that when you get that income, the cost of goods sold goes along with it. And I don't know if they calculate it or not. I mean, there's no documentation out there that says they do. You have to assume they do. I don't know.
Yeah, no, that's a good point. And yeah, that's like one of the most confusing parts too. It's like, and yeah, I think I know you talk about a lot, like about leakage and returns. And I was using a service to kind of like list it on eBay, and then it's like kind of not working out. So I'm starting to get the returns back here. And it's like kind of sad just like to see a pile. It's like, yeah, that's like $500. There's another 500. And like some of the stuff's just broken and damaged, and it's just like,
Yep.
it's rough.
To kind of wrap up that whole question there, because there was a piece I did not mention before, which I'm not sure how like deep in the weeds that he's asking this question on, but deep in the weeds would be if you're specifically wanting to know like how to actually handle the actual adjustments, that sort of thing. Theoretically, what you should, which this is like way in the weeds, but I'll explain it really quickly. Theoretically, what should happen is that when you buy items, it goes into inventory asset. Then when items sell, it gets moved from inventory asset to cost of goods sold. Then when items get returned, if they're unsellable, then they should basically either be moved from the cost of goods sold to an actual whatever you end up doing with it. So if you end up throwing it away, it goes to an inventory waste category. If you donate it, then it goes to charitable contribution category. If you go basically just go down the line of whatever you physically do with it, it should be moved out of cost of goods sold into whatever category you have there. Now, if it's a sellable good, it should move back from cost of goods sold back into inventory asset. So again, sorry for like a minute of like totally in the weeds, but I didn't know how deep you want me to go into that question. So that's kind of like the actual answer of what you should be doing with that. I want to make sure that all the context I talked about beforehand made sense before I went into that like in the weeds crap.
He said, thanks, Chris. That was great. Let's see what else we got here. Someone asked, do you need to report taxes every 3 months? If so, how do you set that up?
So what I think that person's referring to is the quarterly tax payments. So if you actually have more than $1,000 that you're likely going to owe by the end of the year, then theoretically you should be sending in quarterly tax payments. That's what you should be doing. Usually what happens when your first year of business, people usually just don't do it because they have no idea what the profitability is going to be. And then when you roll into your second year, you're going to end up doing your taxes on your first year in around April or so. And if you end up owing more than $1,000, then theoretically you might have an actual penalty based on the fact you didn't send in the quarterly payments. And at that point, there will be an estimate that you'll have for the upcoming year, and based off of those numbers from prior years. So at that point, you potentially would send in estimated payments. Now, theoretically, if you don't do it at all, the only real penalty for doing that is that when you do your taxes in April, is you end up just owing a penalty rate, which is about like 7%. So what some sellers do is they just don't bother with it because they just realize it's basically a 7% loan.
Yeah.
It's basically a 7% loan at that point. So if they're able to take that money, put it into more inventory that they would have spent on taxes, then they can basically make more money off of it, and then just make sure at the end of Q4, when they actually have all the cash from selling everything off, they actually then set the money aside. That's kind of like what the gist is there. Is effectively you're just giving the loan. They're basically giving you a loan. Effectively, is what it is if you don't make those payments. But other than that, there's really no penalty per se. It's not like you're going to get thrown in jail. You're not going to, there's no tax fraud. There's none of that. But yes, technically you should be doing quarterly payments. But the penalties, if you don't, are pretty much just paying interest on it, which is actually cheaper than an Amazon loan in some cases.
Yeah, I remember like when I first hired, I was so scared of like, oh, I'm gonna get audited. He's like, it's not like they just come in and like kick in the door. It's like a very like, hey, like we just have some questions and like we go through it together. And I was like, okay, that doesn't like sound too bad, kind of thing. Going along with taxes, a lot of people talk about kind of cash back with Rakuten. Do you have to pay taxes? Like you get cash back with credit cards. I know it's a touchy subject, but what is kind of your thoughts surrounded by that?
Yeah, this is always a fun one because it's a question that there never is a good answer for it. And the reason why there's no good answer is because the IRS has no official guidelines of how to handle it. There's these various guidelines, there's various court cases that kind of like steer you in the right direction, but there's nothing that specifically says X or Y or Z, and which is the reason why you get 10 different answers based on that. So you kind of almost have to infer what the IRS is expecting you to do, and then you have to then make a decision on what risk you're willing to take based on whatever those assumptions are. So in this particular case, there is one thing we know for sure is credit card rewards are absolutely not taxable. Those are not a problem at all. What I'm referring to here is like if you're getting points on your credit card and you're utilizing those for something other than cash. So that would be like gift cards or using it for mileage, for flights, using it for gifts, that sort of thing. None of that is taxable. There's actually a publication that has come out that specifically says an opinion on a similar situation from the IRS that specifically says that is not taxable. So we know for a fact that that's true. What we don't know is all of the other stuff you just mentioned. And the reason why it's like so gray is because you have to look at it from a point of view of is if the money came in as actual income to the business, then and we know it's there, we're kind of underneath an obligation to report it because the IRS tells you that you have to report all income. There is no specific exclusion that says if it's cash back, there's no specific exclusion for that. And generally, if there's no exclusion, then the generalized tax rule is you have to count as taxable income. Now, there's arguments out there that people say, well, it's a personal credit card, and then it's for personal credit cards, it's not taxable, and the reason why is because it's just a rebate on the purchase of the item, and you don't pay taxes on rebates, and so that's the philosophy that a lot of people run with. Well, The thing is that you're buying cost of goods sold. And so you're buying inventory. So what's happening is that you're getting a rebate, which is exactly what's happening when you're buying it personally. It's not taxable when it's personal, but when you're buying it with a business, that actually lowers the price of your inventory, which now means that it's taxable because you're lowering your price of that. When you sell the item, you're just lowering the price and you're having to pay a difference on what you're selling it for. So that's kind of the reasoning why that my general stance is that if it's going into the business in some fashion, which means that if you're getting a check, it's deposited into your bank account, in your business account, you have to report it, because if we don't, how would we defend that? There was money that came into the account. We don't know where it came from. Yeah, it came from cash back. Sure, let's just go ahead and say it's not taxable, because there's no law that says it's not taxable. So that's
Right.
basically where the issue is. Now, on the other side of things, is let's say you get like a Capital One Spark one, and they give you the ability to just mail you a check to your house, and you decide to just deposit into your checking account. Not part of your business, right? That's one of those cases where it's like, that one is very gray, because the reality is like if you ever got audited on your business stuff, you probably would get audited on the business. If it never saw the business, kind of never happened theoretically. Um, that's you can kind of infer what I'm saying there. Uh,
Yeah, because it's weird too. Like, so I get a Rakuten check like made out to me. Like,
yep.
Be Frugal like Venmos me, and it's just
Mhm.
like, yeah, like kind of, what do you do with this, and like, how do you handle it?
Yeah.
And it's just kind of like
Yeah,
gray,
and
I guess.
I can tell you a lot of sellers just to put in their personal accounts is what they do, and they don't claim it. That's what a lot of sellers do. And us as an accounting firm, if you tell us that, that's not good. But if we don't know what ever happened, we have plausible deniability that it never happened, and we go from there. But the reality is that if we don't know what happened, it didn't happen, and it's on the person who's doing the action, how you want to handle it. In my case, if you tell us to do that, we basically have to give you advice to say you got to claim it. That's kind of the advice we have to give, because if we don't, then we're potentially breaking IRS guidelines. But again, more or less telling you what a lot of sellers do. And if I was a seller, I would probably deposit into my personal account and act like it never happened. That's what I would do if I was a seller. Now,
Since
it's
we're
not a
on
lot.
YouTube, I will not say what I do with
Yeah.
mine.
Yeah, I mean that's what I would do if I was a seller. But the reality is that theoretically, yes, I could get audited, and they would start asking where does money come from, and then I may have to defend that in an audit. And it's possible that could be tax fraud, but again, there's no guideline that specifically says that. So it's a very very gray area, which is why you get so many different answers, and why, if you notice, the way I'm answering it is not like definitive, because there is no right answer there.
Yeah, it's probably not a big enough thing that would be worth writing like all this stuff about. Like, I don't know, like how many more other people it would affect besides us.
Yeah, I mean, it doesn't really affect any other like business heavily, like the business that you're operating. Like, I mean, there was a year where I had over $300,000 of cash back, so I know it can be a lot of money. Uh, but it's like one of those things. Like, well, what do you do with it? Like in that case, and here's another thing to kind of think about too, which actually has nothing to do with the taxability of it. Is for some people that cash back is a large chunk of their profit.
Mm,
And if their goal in the future is to actually get loans, they're going to want to show profitability on their actual tax returns. And especially
okay.
if like you're 2 years into your business and you actually now have the ability to get like an SBA loan or get something through a local bank, they're going to ask for the last 2 years of tax returns. And if you magically hid $60,000 of income because you deposited to your personal, and now your tax return only shows you made $30,000, you're not going to get approved for that loan. And it's the same problem if you're trying to buy a house, or that's really the big one, is trying to buy a house too, especially if you have no W-2 job to go along with it. It's a huge problem. So that's kind of like the other like hidden side you have to think about that when you're making that decision is, is this going to screw me in the end? And in my case, we actually did claim it all when when we were running our business. We claimed it all because I wanted to be able to show the income so that way I could actually get the loans. But
Ah, okay. Makes
and so
sense.
that was kind of like why I wanted to make sure I had that ability, because I wanted to be able to get the loans. I want to be able to show as a growing business. And obviously, at some point in the future, if you're ever going to try and sell your business, you're going to want that income to be in there too. But again, like RA businesses, OA businesses, not very sellable. But it's entirely possible that if you start running a heavy like wholesale business, it can make a big difference. So that's just kind of one of those things to think about.
Yeah, no, that's a good point. I've never really heard anyone kind of tell the other side of that because, yeah, I guess it would make sense. Yeah, it's great just to like put in your bank account, but then like if you are trying to grow the business and then like they're like, well, where's all your revenue?
Hmm.
And you're just kind of stuck, and then you're in like a sticky situation, I guess.
Yep. Yep.
What are some of the biggest mistakes you see kind of new Amazon sellers make when they first start in terms of like accounting or just in general?
The biggest problem is they're not tracking anything. that's that's probably the biggest problem is they're not
Crazy.
tracking anything. The second problem I tend to see too is that they immediately start like putting stuff on credit cards with their personal purchases too. So like they'll go to like Walmart and buy like some candy and buy some their groceries for their house, and then an hour later they use the exact same credit card to do some sourcing, or maybe they're even in a store at the same time. They do two purchases on the same card, one for business, one for personal, and it's the same exact card. And so the challenge of that is number one, it makes it ridiculously difficult for bookkeeping, especially if you try hiring a company like ours. Like we literally have to like ask you, all right, which one of these are personal, which ones aren't they? And then you have to go through there and dig through and figure it out. It's an absolute mess. And the other side of it is that for audit purposes, if you ever did get audited, it makes it significantly more difficult to be able to defend what you're doing if you're buying groceries on one receipt and then doing sourcing on the other at the same store. And same sort of thing, like when you're doing arbitrage, you're buying in a lot of like retail stores. So it looks like it's personal. All of the stuff looks like personal purchases, and you have to basically justify that it's not a personal purchase. And so that's kind of the way that's kind of the angle that they come out with. And one line of defense that you would have is I always keep one on one card. I always keep personal on one, then business on the other. It makes it a lot more defensible because as soon as you can start showing the pattern and saying, yes, every single thing on here is business, they likely won't start questioning every single line on there if you have that store and you're able to show that, yeah, this all lines up. They're like, okay, cool. But if you start like handing them something and they start digging into it and they're like, oh, why is this not lined up properly? And then it's like, oh yeah, I put my personal stuff on there too. And then they're gonna start questioning every single thing on that report that you're putting and trying to do, which is not pretty. You're not gonna want to deal with that. So by far, that's probably like the biggest issue I see with someone that is keeping track of their stuff is put on the same card. Really, your best goal should be so if you have two credit cards, use one for personal, one for business. And it's okay to use two personal cards. It's okay to use a personal card for business. It's just putting personal purchases on the exact same card that you're doing business as well. That's the biggest issue there. So yeah, I would say just not keeping track of numbers, putting stuff on basically not separating them out are probably the two biggest ones I generally would see. And then the third one, as they start to grow, is they basically just don't keep track of how fast they're selling their items through. They're not tracking their inventory turns. And what tends to happen when they're not doing that is they get in this massive cycle, right? The cycle is they buy all their inventory, it starts selling, then you have this like lag period of when you actually get the money into your account, and lo and behold, here comes your credit card payment, and they're basically scraping together to try and make this credit card payment, and then they're like, okay, I cleared off $5,000 on my card. Let's go buy $5,000 more worth of stuff. And so that's what they do. They buy more, max the card out, and then they're still not getting the money back in from Amazon because there's this huge lag time, and they're not selling through their inventory fast enough, which then causes those huge cash flow problems you hear a lot. So then the solution for a lot of people is I need more credit cards. And so that's what they
Yeah.
do. They get another credit card, or they go try and get financing from somewhere else, or they take out an Amazon loan. They start doing this huge death spiral of credit cards and loans. When the reality is that probably like you're not learning anything from this because more than likely like 40% of your inventory might be absolutely trash and you're just not dealing with it. Like you're just looking and you're like, oh yeah, I'll hold out for the cost. The price will come back up and bounce back up. And so it's waiting for it to bounce back up. In the meantime, like they're just screwing themselves because their cash is just non-existent. And so that's kind of like the other problem is they're not watching their inventory to make sure it is actually selling through. And I would say a lot of healthy sellers we have generally sell between 60 and 70% of inventory every single month is on average
Wow.
what we see.
Well, yeah, that's a good. I was actually going to ask you what's like a healthy. What did that look like? But yeah, I actually ran into that problem like a month or two ago where I just bought like a lot of high rank stuff to like test
Yep.
stuff and didn't really bounce out with like fast moving stuff and just like trying to liquidate all that was like super painful.
Yep. Yep. And it's actually pretty easy to spot it too. I'm looking through financials. Is there's a certain range I tend to see within cost of goods sold for most arbitrage sellers. And when I see it really low, I start questioning it because usually it tells me they're not liquidating their inventory, especially when I combine that with low inventory turns. So if I see low inventory turns in conjunction with very low cost of goods sold, usually that means that they're not liquidating their inventory fast enough, because generally what happens is that when they start liquidating inventory, their cost of goods sold actually rises because they're basically selling stuff at cost or lower than cost, which then drives up that percentage. And so typically that's a very big indication when I'm reviewing reports. That's one of the questions I always ask when I see those two factors in play. I'm like, you're probably not liquidating your stuff fast enough.
Yeah. If someone doesn't know, how could they figure out their inventory churn?
So the easiest way to do it would be to basically take what your cost of goods sold is, and then divide it by your actual inventory that you have at the end of every month, and just see what it is, and then just basically track it month over month and see what those numbers are. So theoretically, if you have $100,000 of inventory and within a given month you sold through $70,000 cost of goods sold, that'd be a 70% turn rate. You basically sold through 70% of your inventory within that month, and then it's kind of one of those things where you have to watch it month to month and kind of see like how it goes. And as long as you're kind of steady, usually you're okay. But it starts like dipping down where you're seeing like you were at 70%, now it's 50, now it's 40. That's easily an indication that you're not selling through your stuff when you should be.
Got it. All right. Two questions. Chris, do you focus more on OA rather than private label? And at what revenue range do you suggest bookkeeping services?
We have clients on in both OA and PL, so we don't necessarily focus either way. I would say that the amount of clients we have is probably more heavily skewed towards OA and RE sellers and wholesale sellers, but we do have private label clients as well. Me personally, I personally sold a lot more in arbitrage and wholesale than I ever did private label. So that's kind of like where my expertise tends to go towards. But we private label is actually easy. Like for
I was going to
bookkeeping
say that
purposes,
must be the
it is
easier one.
it is ridiculously simple compared to OA clients. When we actually have private label sellers come to us, we're like, yes.
Yeah, when I was selling books, it was so easy. I had three sources, and it was like money in, money out. Like it was always less money. Like you're making like, I don't know, 50, 60% ROI on this stuff. It's like not that hard to track. Like
Yep.
nothing's
Yep.
getting lost really.
Yep. And I think the second part of the question was, when should they start some
Oh
sort of
yeah, when should you
bookkeeping?
start?
So I would say that realistically, in any business, you should start bookkeeping the moment you start it. Now, the question really lies at that point is, can you afford it? And so some private label companies come into it knowing that they're going to lose money for, let's say, 6 months or a year. And so they can kind of just budget that they can budget the bookkeeping as part of that. A lot of OA sellers and RA sellers, they're basically doing I'm starting from zero and I just need to grow up, and they have no cash other than what they have for inventory. In those cases, usually you have to wait a little bit to potentially hire someone for bookkeeping, even though they theoretically should need it sooner than a private label person. So I would just say more or less, like once you start getting to a profitability level where you feel like you can afford to potentially pay someone to do your bookkeeping, is when you probably should do it. Generally for like OA, RA, wholesale, that's usually about $10,000 to $15,000 per month in revenue. For private label, it could be even less than that because their profits are generally higher. But again, their complexity is a lot less on the private label side, so it may actually even be higher in some cases. It just kind of depends on how you're personally tracking things within your business. Because again, like OA has so many moving parts, whereas private label, in some cases, you may have 5 expenses in a month because all you're basically doing is like photography, your inbound shipping that you have from like your freight forwarding. Then you have the actual cost of the items that you sold, and maybe some pay per click, and then your Amazon fees. That's pretty standard what we typically see. And then you might have literally 20 transactions a month, which is a very, very simple thing to track. But again, it's one of those cases where you want to have the full picture of your business. And if you want to have that, I would say as soon as you feel you realistically can afford it is probably when you should do it. And generally, like in our case, our minimum cost for like the lower end clients is about $200 a month. So if you're at the point to where you feel that you can afford $200 a month to get it taken care of, and that's kind of where it is. But keep in mind, it's like for sellers that are underneath like $10,000 to $15,000 per month, and as we go up, we start to charge more as you go up because we basically have a pretty standard rate. We typically charge for most people around 50,000 a month, and then we kind of like give discounts based on what your rates are from there.
That makes sense. I just had a question. I just forgot it. So for a beginner or someone who's like kind of not familiar, like how might it work working with like a bookkeeper and a CPA? Like what does it actually look like?
Yeah, so what will typically happen is we will first, especially if you're cleaning stuff up. So the first question is do we actually need to clean anything up, or are we going to start fresh at a certain point in time? Generally, if you're kind of coming to us, let's say you're coming to us in October, that's really pretty much your options are you either go back to when you started, if you started this year, or you go back to January, or you just wait till January of next year and just kind of deal with your bookkeeping this year and hope it's okay for taxes. Because the reality is like if you tell me to start like now, you're only really getting like a month to 2 months worth of bookkeeping. And then now you're also having to deal with a separate set of books for all the other 10 months out of the year. So it doesn't make a whole lot of sense this late in the year usually to kind of like to start now. So you usually want to go back in time or start. So then once you've made a decision on when you want to start, if we're going to do some sort of cleanup job, then generally what we're going to need is we're going to need access to your bank accounts and credit card accounts. So the access we're asking for is generally just read-only access. We don't want to be able to touch your stuff. And so we get read-only access to those accounts. We will set you up on QuickBooks, and then we have you connect all of your bank accounts and credit cards, and we'll go through, we'll actually categorize everything, unless like we run into a situation like someone like really split up their personal business on stuff, then we kind of need some input from the sellers. So in some cases, we'll give you a list of stuff and say, tell us what the stuff is. But then once we kind of like get through the cleanup portion of it, it's relatively simple. We're pretty much just importing transactions. We're categorizing everything. We're reconciling everything, make sure to write. We're importing stuff from Amazon. We're giving you reports. And then usually like an ongoing basis, the only things you have to really worry about are, we'll ask you for, again, unidentified transactions. That would be like you randomly bought something, we just don't know what it is, which does happen from time to time. If you had like let's say a vehicle purchase, you need to let us know. So stuff like that, we would need to know about that. And then keeping up with your cost of goods sold or your buy cost in your inventory management software, whether that's Inventory Lab, Seller Board, or one of those sort of tools. And as long as you're keeping up on those, that's kind of about it. For OA sellers, there still is a piece that you still have to kind of like do, which some people confuse with bookkeeping, is you still need to track what's going on with your orders. So like, for example, when you place an order, you need to be able to track when it got delivered, whether you actually got charged for it, whether you got double charged for it. You need to track the refunds and those sort of things, because that's not really a bookkeeping task. That's just a internal task that generally a VA would do, or if you're a solo person, then you need to do it yourself. But that's not part of bookkeeping. That's literally just an internal like function of your business you just should have.
Yeah, no, that's a really good point that you bring up too. And I feel like a lot of what I've learned from kind of like going through the bookkeeping process, it's like just like don't be afraid to ask questions, because it's like, oh, like I don't know what any of this means, or like, is this business healthy? Like, obviously I have some idea, but like it's also nice when like you have a balance sheet and like, because this was the first year I've actually had like actual balance sheets and stuff. I was like, wow, like this is much
Nice.
different, and like this is really nice to have this and be able to look. And I'm like, how do I know? And then it's like, oh, if the inventory evaluation matches or it's like close to Inventory Labs, like we're pretty much on track. And it was. I'm like, okay, like I feel better now, like knowing that like this is like working correctly.
Am I taking up all of Michaela's time to talk? It feels like she hasn't said a word today.
No, you guys are doing good.
Okay.
I'm just
She's,
listening.
yeah, she's usually in an echoey place or like a car or something, and just chirps in when necessary. Uh, what else do I have here? What are some of the? I know you like to talk about this. What are some of the things that you see on social media that really can't be written off versus things that can be written off?
So I think what you're seeing in a lot of these cases is they're telling you what can be written off, which theoretically a lot of these videos are telling you can write something off. But it's the context that's the problem. Because the way a lot of these like TikTok videos will say is, oh yeah, you can write this off if you own a business. You have an LLC, you can write this off. Yes, you can in the right context. So like an example of this is that you see like the whole like I'm going to buy a G wagon for my business and I'm going to write off $100,000 this year against my profit. And yes, you can do that logistically. You can, but the question lies is it actually able to be used in your business? If you're an RA business, Okay, you can justify that. You can justify buying it because you're driving around all over the place. You need a big vehicle to collect your stuff. If you're doing strictly OA, like, why do you need a G-Wagon? How would you ever defend that in an audit? Realistically, how would you? Because realistically, what happens at that point is that you're also supposed to keep track of all of your mileage, even if you're not writing off the mileage. You're still supposed to keep a log of your personal versus your business mileage, which no one ever does. So theoretically, if you don't keep track of that mileage, you're not keeping track of what you're using it for. Then it defaults to, okay, you need to have like some sort of legitimate reason for doing this if you were to get audited. And how would you justify it realistically? If you had an OA business where the only driving you have is to basically possibly drive to a UPS store every once in a while to drop some stuff off, how would you justify it? You can't. You just can't. And so that's part of the issue is that, like, specifically with the style of businesses that we're operating, like RA is about the only one that can actually really be justified. And if you're not RA, then you have to basically say, okay, well, if I'm going to buy a business vehicle, am I just going to let it sit in my driveway the whole time? Am I going to, like, or am I just going to use it for personal, which is honestly what most people are trying to do, is they're trying to write off their G-Wagon and then use it for personal stuff. That's basically what they're trying to do, which is illegal. It's illegal to do that. So the question lies is, do you want to get boffed on the back end for doing that? And then the other thing they never talk about with that specific deduction is, let's say, for example, you bought a vehicle for $100,000, which right now there's actually the bonus depreciation. Like last year, you would get the whole $100,000 off the first year. This year, it's only 80%, so you get $80,000. But what happens is it basically takes whatever that deduction you're getting that first year, basically drops the price that you pay, the price you paid for it, down to that amount. So whenever you decide to like sell that vehicle off, which in some cases you typically do, you typically sell a vehicle off at some point. If you bought it for $100,000 and you wrote off, let's say 80,000 of it right away, it now means that you theoretically bought it for $20,000. So let's say you sell it 3 years later for $60,000. You're not on the hook for $40,000 in taxes. You're not on the hook for $40,000 of income, because you've already deducted $80,000 of which took it down to 20. Because all you're basically doing is that deduction is just a depreciation number. That's all it is. Now, if you never sell the vehicle and you basically just junk it out or throw it away, then yes, you end up getting the full deduction. But if you ever sell it off, it's the basis that's the problem. So that's one they never tell you in any of these videos, is that when you sell it off, you're getting hit with any amount that you didn't do. And if you go out of business, same thing. You go out of business, you're now socked with the whole difference between what's currently worth versus how much you've actually written down. So that's part of the issue there too. So that's probably a big one. Another big one is like the Augusta rule. Everyone likes to talk about the Augusta rule. If you haven't heard about that one, it's basically where you can charge your house. You can basically collect money for rent from your business, and it ends up being a deduction on the business, but then you don't have to claim that money as personal income. And yes, that is a legitimate tax deduction. You certainly can do that. The way it's supposed to work, and the reason why they did this, is the reason why I named it the Augusta rules, because people would, for the Masters, I believe, is in Augusta, Georgia. Yeah. And so what happened is that these people would rent out their houses for a week, and basically they made that tax deduction for those people. So that way they wouldn't have to claim that income for any money that came in during the week they were renting it out. That was the whole reasoning for that tax deduction. Well, then people said, well, if I can just like rent it out to myself, then I get a tax deduction. And theoretically, yes, you can do this. But again, there has to be a legitimate reason why. You have to be able to defend it. So again, if you're working out of your house and you have no one working for you, which is a large majority of small scale OA sellers or RA sellers, what's the justification for you supposedly renting your business out to yourself when you don't work anywhere else? You can't. You just can't. Sure. Now, let's say, for example, you have a warehouse and you have a staff of like 10 people. And once a month, you have a business meeting at your house. And at this business meeting, you have a catered lunch. You bring everyone over there and maybe just have a good time, whatever. That's justifiable because you have a staff and you're doing an actual business meeting, which means theoretically you'll have receipts for your catering. You'll probably, at that point, need to have like proof of how much it would have cost if you went somewhere else to actually try and do this at. And then you may have like business meeting notes, and then you potentially, to defend this also, you would have like maybe a calendar invite to all of your employees. So you could basically show this whole picture of, yeah, we actually did have a meeting at our house. We invited everyone over. We did our business meeting. We went through this, and it's legitimate. But what people are trying to do is they're trying to not have legitimate stuff, and they're just trying to write it off, which doesn't work. One last one I'll throw you at too is the kids thing too. It's another one I get asked a lot too. Is, well, I can just like pay my kids $13,000, now let's pay taxes on it, now I get to deduct it. Again, if you have a 3-year-old kid, what the hell are they doing for $13,000 a year?
Yeah, that's a good
Really,
point.
what are they doing? Like even if you have them, like let's say you're doing a private label product and you're selling baby clothes, like yeah, you can have them pose for the baby clothes, but how much would you actually pay someone to do that? You wouldn't pay them. You wouldn't pay someone else $13,000 to pose for this stuff. You may pay $3,000. That's justifiable. But again, it has to be justified, like logically. And sometimes you can kind of stretch the way you can logically like present things, because realistically, we've seen some people have all like this is a story I've heard. It's not something we've done, but I've heard a story like on the Augusta rule where they basically put together the documentation showing that they had business meetings. They put together the documentation showing they had uh, concepts. They catered to their house, but they never actually did the business meetings. you know, they never actually did them. But they had all the documentation to prove that they did, which means in an audit they probably perfectly fine. And so that's kind of like an example of a way you theoretically could skirt the law on that. But again, it's not legal to do that. But that's I've heard people doing things like that you probably shouldn't do, but I've heard people get away with it. And so that's kind of why when you see all these like videos, like yes, a lot of times they are accurate per se, but there's always context behind it, and it has to be like, does it actually make sense for you, and does it actually make sense? And back, one last thing on the vehicle thing: if you're buying a G-Wagon and now you're paying $1,000 a month for your vehicle, can your business even afford $1,000 a month payment?
That's a good point.
Anyway. when you think about something smaller, you could have bought something smaller, paid like $400 a month, maybe $500 a month, and got the same thing. Got the same usage of it. Yes, you get a tax deduction, but again, you get screwed at the end. You get screwed on the backside. So whatever.
Yeah, no, that's yeah. I guess like they just kind of see like all that flashiness and don't really like kind of think it through.
Yeah, I mean, if you're making millions upon millions upon millions of dollars and you're trying to find random tax write-offs, then all of those probably apply to you. You probably will literally look through every single possibility you can think of through the tax code and try and find things. But if you're just like a normal seller that's probably underneath like a few $1,000,000 in sales, like these are never anything you should even be worrying about, because almost always your biggest deduction is going to be inventory. Almost always, especially if you're on cash basis. If you're on cash basis, your inventory is always going to be your number one expense. And then if you're on accrual basis, then the question lies is, do you actually have some sort of cash to put somewhere? Because when you're doing deductions, you've got to put cash somewhere. Like, for example, if you are paying your kid, you're supposed to be paying your kid. You're not supposed to say you gave your kid $12,000 just left in your business. You're supposed to literally remove $12,000 and give it to your kid. Like, that's how it's supposed to work. And so can your business actually afford to lose $12,000 when you need that money to grow your business for inventory? Probably not. And so that's kind of like when people ask these questions too, is like, can your business actually afford doing this stuff? And that's that's kind of what it boils down to. So a lot of sellers, like, there's just not a whole lot you can do until you get to a certain level. And generally the certain level is, I now have enough money going into my business where I can actually start spending money on stuff that gives me deductions, like putting money into a retirement account. Again, if you have no money to put into a retirement account, you can't get a deduction. And so you have to make a decision: am I going to put in retirement, or am I going to put it into inventory that's now going to grow my business even bigger? That's the option you have. And so, yeah. Sorry if I rambled on too long on that.
Oh no, that makes a lot of sense. Is there a rule of thumb, do you think, of like how much, like a percentage that you should be putting aside for taxes, like based on your profit? Like
Yeah, I
monthly,
mean,
or how would you like kind of not get surprised, I guess?
if you legitimately didn't want to get surprised, then I would hold back somewhere between 15 and 20% of your actual profits. Now, keep in mind that your profits are different than your actual payouts from Amazon. Some people say, oh, yeah, you should say 15% of every single payout you get from Amazon. Oh, hell no, that's way too much. I actually did the math on a tweet recently, and I think the math was something like 1.5% of a payout is what generally you should do, if that.
Wow.
Assuming you're at a normal profitability level, we would normally see with most OA sellers, which
Okay.
normal profitability levels would be somewhere between 6 and 8% of sales. Is pretty normal for what we see after you take out all of your deductions. So if you're in that range, then it would be 1.5 to 1.75%, something like that, of your payouts is what you should take. But there's actually a tweet I put out that literally works through the math. So if you go on my my Twitter at some point, you just do a search for, I imagine you search for, I don't know, you find it.
Yeah, just type in Chris Potter.
Yeah.
What is, I guess we got 10 minutes here, so if you guys have any last minute questions, drop them in the chat. What would be like kind of the best way to go find an accountant, or you want to say how they could find you or whatever, but what's the general process of maybe how do you know they're a good fit for your business?
Yeah, so realistically, a few things to think about when you're determining who you should work with is in the e-commerce industry, there's a lot of nuances that a lot of CPAs and a lot of bookkeepers just don't understand. And so your question should be initially, depending on who you're talking with, is how many other people do you have that do e-commerce that you're doing books for? If the answer is 0, you're probably talking to the wrong person, because I can almost guarantee you they will do something wrong. We've fixed so many people have either done their own books or done their own taxes or had CPAs do their taxes. They didn't understand it. And there's like, I'll give you a very simple example I've seen from a legitimate CPA who is extremely smart CPA, knows nothing about e-commerce, and he basically put in there his income because it shows on the 1099 all the sales tax that was collected by Amazon, but then never actually put the deduction for the actual sales tax on the backside for stuff that was actually sent out to the customers. So what ended up happening is they end up showing like $7,000 more income than they actually had, which then when you factor out taxes, they probably paid about $1,600 more in taxes than they should have. And so that's just like one example of something that a CPA does not understand how Amazon works. They do things like that because they just don't understand. And so that should be like your first question is, have they even dealt with this sort of business before? Because it is different than a lot of other businesses. Like if you're like just like a nail salon on the corner, regular CPA can handle this perfectly fine. E-commerce, totally different beast. Totally different beast. That'd be option one. Then you can start asking them like questions about like, about your business. Like, do you know about X? So like you could ask them that question that you asked me earlier. How do you handle cash back because I'm buying cost of goods sold with us? And if they don't know what the hell you're talking about, they probably don't understand your business. And just all sort of things like the questions that you've asked even me on this call, which I've obviously answered because I have no problem answering any of these. You ask those same exact questions to a CPA that does not understand e-commerce and see what answers you get. That's really what it boils down to, because they're not going to give you the right answers. They're going to be like, let me find out, or they will guess and not have the right answers. And yes, theoretically, you can say that maybe I don't know the right answers either, but I can tell you I've been in the industry for now 15 plus years. Like literally, I started selling in 2008, and so I'm sorry, went full time in 2008. I started selling in 2005 is when I started selling. So we're talking like 18 years now. I've been in some semblance of this industry. So the question lies is the person that you're working with understand it? And obviously, I'm not the one doing your taxes. I'm not the one doing the bookkeeping, but all of my knowledge has been filtered out to all of my people. So that's kind of what it boils down to is, do you have the right person that actually understands your operation? If they don't, you probably should look for someone that does.
Okay. So with the holidays coming up, everyone's going to be talking about most likely Kohl's Cash and other stuff like that, rewards cash. What would, in your opinion, what would be the best way to account for that? Like, should you take the
use the Kohl's Cash personally? Use it personally.
Use it personally. Okay.
Use it
so
personally.
You just pretend that you wouldn't assume a discount at first. You just buy it. That would be your ROI, and then use it personally.
Yep. Yeah, because basically what the deal is that if you, let's say, for example, you take that Kohl's Cash and you buy more inventory with it, then what happens is that when you use that Kohl's Cash, you now have to discount your inventory to whatever the amount is that you paid for it when you bought it, which is minus all those discounts of Kohl's Cash, which now means, let's say, for example, you sold mine for $100 and the original price, if you would have bought it, would have been, let's say, $50. And because of the Kohl's Cash, you only paid $5. And so theoretically, on an item that you bought for $50 and you sold it for $100, by the time you back out all of your Amazon fees, blah, 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 maybe you made like maybe $8 or something like that, $8 to $10 maybe, so roughly. However, if your cost of goods sold is only $5 because you use $45 of Coles Cash, now it's $45 plus 10. So now your actual profit on this is $55, which now means you have $55 of taxable income versus $10 of taxable income. So you effectively tax all of that money you're using for Coles Cash, which is why if you use it personally, it's basically just like having income at that point that's not untaxable. So, and that's a legal way of doing it. It's perfectly legal to do it with rewards. It's the fact that you once you use them within your business to buy inventory, you have to claim it. There's no options.
Got it. Yeah, I definitely think a lot of people are making that mistake then where they're factoring in like 20-30% off at the buy and then doing some other crazy math
Yep.
to kind of justify. Is there anything else you want to leave with? Give people some advice or where they can find you, all that good stuff, and we'll wrap it up.
Yeah, certainly. So, if you're looking for help with your bookkeeping, taxes, that sort of stuff, feel free to reach out to me. You can find me on Twitter. It's Chris Potter 361 is my Twitter account. We also have talookadvisors.com. There's also, if you actually go on talookadvisors.com, on the top, there's actually a link up there that says resources, and you'll see one on there. It says 7 Profit Crushing Mistakes ebook. So I actually have an ebook that I put out that literally like outlines the most 7 common mistakes I have, and so I would recommend going there, downloading that, and that at least like will start to tell you some of the things that will be an issue with your business. And if you do want to work with us, right on our website, you can schedule a free strategy session with us. Unfortunately, I'm booked out very, very far out, almost a month at the moment to actually talk to me for any sort of calls. But if you're just like, I just want a quote, I know I want to work with you, just give me a quote. There's actually contact us thing down at the bottom of our website. Just contact us and say, I'm just looking for a quote. We'll send you a form to fill out, and then we'll get the quote for you without having to talk to me on a strategy session. Or if you want to DM me on Twitter, then you can just DM me on Twitter and just say, hey, I'm just looking for a quote, and then I'll ask you for the right information, and we'll get you a quote probably with about 48 hours. So if you don't effectively want to work with us, that's cool. We'll go that route. But if you're like, you know what, I really just want to talk about my situation, unfortunately, there's a wait because I actually do a total of like 13 calls a week, something like that.
Wow.
I just can't do more. I just can't do more because I'm so busy trying to actually run the business. So
I can imagine that is a lot of calls.
Yep.
All right. Well, thank you so much for being here. Definitely check him out on Twitter. We'll have stuff linked below. And I hope you guys have a great weekend. And thanks for being here, Chris.
Absolutely. Thanks for having me. And it's been nice talking with you, Michaela. So many words.
Yeah.
All right. Have a good one, guys. Happy Q4.
Yeah, happy Q4. You too.